For decades, real estate investing followed a familiar script: buy a house, rent it out, wait for prices to rise. Condos, single-family homes, and office towers dominated conversations at dinner tables and investor conferences alike. But quietly, almost unnoticed, that script has started to change. In Canada and across the global market, some of the most sophisticated investors are no longer chasing traditional residential or downtown office assets. Instead, they're putting serious money into properties that barely existed in everyday conversation a decade ago. Data centers humming with AI servers, climate-controlled warehouses storing pharmaceuticals, student housing linked to universities, and medical buildings designed around healthcare delivery rather than aesthetics. This evolution isn't a trend driven by hype. It's a response to deeper forces reshaping how people live, work, age, shop, and store data. And it's changing what real estate means in the modern era. Why investors are looking beyond traditional real estate. The shift toward niche and non-traditional real estate asset classes didn't happen in a vacuum. Several pressures converged to push investors outward. First, traditional assets became harder to justify. Residential prices in many Canadian cities surged faster than incomes, compressing yields. Office buildings, once seen as stable long-term investments, were thrown into uncertainty by remote and hybrid work. Rising interest rates further squeezed profit margins, making it difficult to rely on appreciation alone. Second, demographics started driving asset demand. Canada's aging population, growing student enrollment from international immigration, and increased healthcare needs created predictable, long-term demand for specialized infrastructure. Third, technology reshaped space requirements. Cloud computing, artificial intelligence, e-commerce, and digital storage don't just live online, they need physical space. And investors realized that servers, logistics, nodes, and cold storage can be just as real as condos and strip malls. Together, these forces pushed investors to ask a new question. Where will people and businesses need space 10, 20, or 30 years from now? Data centers, the digital backbone, becomes real estate gold. Data centers are perhaps the clearest symbol of how non-traditional real estate entered the mainstream. These highly specialized facilities house servers, networking, equipment, and cooling systems that power everything from streaming platforms to banking systems and artificial intelligence. What makes them investor-friendly is certainty. Data usage continues to grow regardless of economic cycles. Companies sign long-term leases, often 10 to 20 years, with strong tenants that rarely default. The buildings themselves are expensive to replace, and power access limitations create natural barriers to entry. In Canada, the expansion of AI development and cloud services has made data centers among the most sought-after assets, even though most people will never step inside one. For investors, invisibility doesn't matter. Reliability does. Cold storage and logistics, the unseen infrastructure of modern life. Another quiet winner is cold storage and logistics real estate. These properties support food, distribution, pharmaceuticals, vaccines, and biologics industries that function regardless of economic mood. Unlike standard warehouses, cold storage facilities require heavy upfront investment, specialized mechanical systems, and strict compliance standards. That complexity discourages short-term speculation but attracts long-term capital. For investors, these buildings offer stable tenants, limited competition, and essentially status. You might not think about refrigeration as real estate, but groceries, healthcare, and e-commerce depend on it. Student housing. Enrollment as an anchor purpose-built student housing has also moved into the spotlight, especially in cities with strong universities and limited on-campus accommodations. Unlike traditional rentals, student housing is closely linked to enrollment rather than employment cycles. Immigration policies, international education demand, and university expansion all feed steady occupancy. In many markets, students are willing to rent smaller units at higher per-bed rates, making returns attractive and predictable. For investors, the appeal lies in consistency. Students come every year, graduate, and are replaced by the next cohort, creating a built-in renewal system. Senior housing and healthcare real estate. Demographics at work. Canada's aging population is one of the most powerful forces reshaping real estate investment. Senior living communities, assisted living facilities, and medical office buildings aren't luxury assets, they're necessities. Healthcare real estate often benefits from long-term leases, government-linked revenue streams, and tenants that prioritize location stability over rent fluctuations. Medical offices, in particular, weather recessions remarkably well because healthcare demand doesn't disappear in downturns. While these assets require specialized management and regulatory compliance, investors willing to navigate complexity often gain stability in return. Self-storage, small spaces, big stability. Self-storage may sound unglamorous, but it sits at the intersection of life transitions: moving, downsizing, divorce, death, and relocation. Demand for storage consistently rises during economic uncertainty and population growth. Facilities have relatively low operating costs, flexible pricing, and diversified tenant bases, thousands of small renters rather than a single large one. That fragmentation reduces risk. When one tenant leaves, the income impact is minimal. Why institutions love niche assets. Large institutions and pension funds are increasingly dominant players in non-traditional real estate. Their size allows them to handle operational complexity, specialized staff, compliance requirements, and long investment horizons. But individual investors aren't excluded. Many now gain exposure through REITs, private funds, partnerships, or fractional ownership models that didn't exist a generation ago. The message is clear. Expertise, not familiarity, now defines good investing. Risks and realities. Not a free lunch. Non-traditional assets aren't automatically safer or more profitable. They carry unique risks. Regulatory changes, technological obsolescence, and dependence on specific industries. A data center without power expansion becomes stranded. A student housing project misaligned with enrollment growth struggles. A healthcare facility poorly managed can face compliance penalties. These assets reward research and punish assumptions. The new definition of prime real estate for generations. Prime real estate meant proximity, downtown cores, waterfront views, walking distance to shops. Today, prime real estate often means relevance. A windowless data center outside a city, a refrigerated warehouse on a highway, a medical building next to a hospital. These properties don't impress at first glance, but they quietly serve the systems that keep modern life functioning. The investors winning in this era aren't asking where people want to live, they're asking where the future needs space. And as demographics shift, technology evolves, and lifestyles continue to change. The edge won't belong to those chasing yesterday's assets, but to those who recognize that the most valuable properties may be the ones you never see, yet rely on every single day.